Hi, Emily.
Hey Dan,
What's on the agenda for today?
how to create a sustainable spending plan for future expenses, when young people should do their estate planning, and how you can tell what's worth following in finance.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, we're taking a big switch from the conversation we had last week, where we were talking about already wealthy people and leaving a legacy and inheritance for your kids and whatnot. And we're just switching to what the kids are up to these days, sustainable spending and all that fun stuff. So, hit me. What do we want to talk about first?
Well, right off the bat, I'm thinking about big future expenses like a trip or a wedding or something of that nature that you're coming in the future. You maybe have a price tag for it, but I wanted to kind of go over the details of what's the best way to fund something like that.
Sure. So fundamentally, it's always going to be easier to save for any big expense or big line item in advance. I think everybody understands that implicitly. The question of sort of the most efficient or effective way to save for something is really a question of risk tolerance and risk capacity. Risk tolerance being how much can you personally handle or take emotionally when it comes to risk, and risk capacity, how much risk can your plan take? And probably the biggest determinant, particularly for the examples you gave, where it's like for a wedding or buying a house or something like that, you're almost certainly talking about a low risk capacity and a shorter timeline in most cases. So when we think about that, a short timeline really dictates that we need to be a lot more conservative in the risks we take. For example, if you say, I'm going to need this money at the end of this year, cool. We should not invest this money in the sense of putting it in the stock market. We should be looking at high yield savings, CDs, money markets, FDIC or NCUA insured stuff. But when your goal is 5, 10, 15 years out, then that does raise a valid question about, okay, given the timeline here, is it worth taking a little bit of risk to see if that gets us there a little bit faster or gives us a little bit more money to play with?
Okay. Well, why can't people just, keep saving into what they've been doing and then pull it out of those accounts later once the day comes? Why do they have to do it that way?
Well, so the biggest thing that often occurs for folks is that they are sitting on money that's losing value relative to the thing they want to buy. So take a look at something like real estate. If you, let's say, for the last 15 years, were trying to save up a 20% down payment on a house, unless you had a very high income and a lot of disposable income, so you could actually afford to really save for it versus letting your investments do some of the lifting for you. If you were just putting that in your checking or your savings, you probably never caught up to that goal of getting a 20% down payment on a house in Boulder County, at least, because you've had real estate inflating at something like 6.5% every year. And so that meant something, as innocuous as putting your money in, let's say, a Wells Fargo savings account paying 0.05%, meant that every year, even though you are personally saving more, the money you've saved so far is actually doing less for you because the cost that you're trying to chase there has been inflating faster than the rate of return you've gotten on that money. Now, in a short term time period, hey, I want to take a trip to Mexico later this year, so I'm going to save a little bit of money every paycheck to pay for the ticket and the hotel. That's not really a big deal. But when you're thinking about a really big ticket item like a car, a fancy wedding, a trip around the world, buying a house and getting the down payment on it, you really need to have a type of savings that's going to keep pace with the inflation costs of that particular thing. Because if you don't, even though you're accumulating more money, the money you saved on day one is worth less towards that objective than it was on the day that you saved it.
Hmm. Okay, well, that makes sense. That's important. What about people that are a little bit older and they're able to pull money out of their retirement accounts, for example? Why don't they just keep contributing to those and then pull money out of those? And I see the face you're making, no one else will, but we have to go over it, Dan.
Yeah, if you're not watching this on YouTube, yeah, the face I just made here. So there's just a lot of problems with borrowing from your retirement. That's not to say you can't do it. There's a number of special conditions, either for exceptions for early distribution penalties, hardship distribution. Certain retirement plans have loan options. There's all sorts of stuff like that. Um, The core problem is that you are robbing yourself blind when you do that. So let's take a really, just a really catastrophic example that I had a good friend of mine do this the first year I was an advisor. They weren't a client. They just kind of asked me my thoughts on doing it, and I told them don't do it, and they did it anyway. But essentially, they borrowed $50,000 in their 401k, and they did it for three different things. They wanted to pay off their car. Their actual hardship distribution reason that they put on the paperwork was that the house they were renting was going to go up for sale, so they wanted to buy it so it wouldn't get rented out or sold out from under them. That was actually at least a decent-ish reason to do it. And the third reason, and I apologize because it's just not a really bad example, but quite literally, it was for all the right reasons, but it was not a good use of the money. This friend and his wife had both lost a ton of weight. We're talking like 150, 200 pounds of weight over a couple of years prior to this event. And a byproduct of that was, and sorry for sort of the graphic example, but his wife essentially had gone from having boobs to not having boobs. And she had a lot of self-confidence and self-image issues that came of that. And so he paid for her to get breast enhancement with part of this distribution. So we bought a car, we bought a house, and we paid for boobs. And you might say that these all sound like really great things. Well, the cost of doing that ended up being for a $50,000 distribution, and it's a hardship distribution, not a loan. They ended up, because they were already in I think the 24% or it would have been a higher bracket back then. It would have been like the 25 or the 30 something bracket at the time. But they ended up paying the actual income taxes, 30 something percent, plus penalties, another 10%. So on their 50,000 they took out, they netted something like $27,000 after all the taxes were factored in. And so there's just that cost where you burned half the money you distributed for this purpose. But the second thing that occurred in that process then is that we've now taken $50,000 out of the compounding lifelong cycle. And unless you save really hard, you're maxing out your 401k to put that money back in as quickly as possible, then you're not going to have that money growing. And so you may have literally just carved a couple years worth of your retirement income off of your retirement by borrowing the money to spend it now.
That's a very painful illustration because it's pretty easy to see the impacts there. I think it's hard for people to see the opportunity cost. I mean, even if you factor in taxes and whatever, and they say, yeah, I'm going to take a hit now, the long term, we took this chunk that hasn't been invested now and it's not growing. It has huge consequences.
Well, and this is really the fault of a psychological construct called hyperbolic discounting. Human beings are really bad at compounding math. Like, we all rationally, when we're taught about it, understand how it works. And if I gave you a pen and paper, you could hand do year over year compounding out to infinity, because the math actually never gets that hard. It's just a basic multiplication question that just keeps repeating itself. But it's hard to mentally do it. So when you say something like, you'll have $1,000, and if you get 10% on it, next year you'll have $1,100. And if you do 10% again, you'll have $1,210. Like, and if you just keep iterating this over and over again, at some point it gets really hard to keep track of in your head. So even though we know, compounding exponential math is sort of an up and to the right swooshy sort of curve over the long term, we're really bad at discounting that back to a present value. And so we have a really hard time understanding what borrowing from something like our Roth IRA or our 401k, or just cashing it out early, how much that's actually costing us over a lifetime. Something as innocuous as $1,000 distribution might cost us something like $6,000 to $8,000 over the course of our lifetime. And so that's really hard for us to do the mental math on. And consequently, that's where, when I made the face earlier, when you suggest something like, well, why don't you just borrow from other resources like your 401k? Because it costs you so much more than the money you're taking out and the taxes you have to pay on it.
I suppose that explains why I've seen you advise many a person who's in retirement and they are drawing on their retirement accounts. That's their stream of income. They're not working anymore. And they'll ask for extra above and beyond what their regular distribution is for, regular things, insurance or a house update, or I want to buy a car, blah, blah, blah. And you always, always, always tell people, if we can save in advance for those things and not increase our distribution, that's ideal. You should treat your retirement income like that, as you would a paycheck from a job, and save separately.
And somebody might question that and be like, well, why take out the extra $200 a month to put in a savings account yielding 1% or something like that versus just keeping it in the stock market or something? It's about having the money available when you need it. and having sort of a stable planned for outcome. But it's also has a lot to do with tax planning. Last year we had clients, and these are some of my favorite clients, so I feel bad describing it, but it's a really good example. Their retirement plan really called for pulling out something like $10,000 a month. And so we expected them to do that. And when we got to their Q4 meeting, when we looked at sort of the statements of distributions, they'd taken out almost 350,000. And that was just the sum of lots of onesie twosie things. We need to, one of our kids is graduating, we need to buy them a car. And then they got into a car accident, so we needed to buy another car. And one of our cars was getting out of date and getting kind of old, so we needed to replace that. And then we wanted to take a big family trip somewhere, so we bought the tickets and the hotel stuff for that. And we needed to get something replaced in the house. Like it was just this confluence of a bunch of unplanned things, some necessary, some generous but not necessarily necessary. And in that confluence, right, we went from being essentially in the 22% tax bracket all the way up into the 30s. And from a planning standpoint, that's not only not sustainable to do every single year forever, but also it puts us in a position to go, well, hold on here, right? We could have planned for all of this, but you didn't kind of give us a heads up on any of this. And some of these were genuine emergencies, and that it's unplanned and that happens. But some of these were definitely not emergencies. And by extension from that, you do have to balance then, okay, if you're suddenly going to be tapping to the tune of several $100,000 more than we had ever discussed or planned for, we need to revisit what a necessary and adequate income is for you, because the estimate you've provided us with in terms of your cash flow and budget does not line up to your consumption behaviors.
Right. That kind of highlights a little bit too the importance of like keeping in touch with your financial planner if you have one, so we can adjust as we go. So you can always, accommodate things that people want to do, but we have to have the information.
And that's a really big piece of it. I also just will say, and this is more to do with people in retirement than it is for younger people, and I'll talk about sort of the distinction here in a second, but what I see for a lot of retired folks is this desire to tinker. So they retire, they're spending a lot more time in their house, and suddenly they decide they don't like their bathroom anymore, or they don't like their kitchen anymore. And it kills me because redoing your bathroom easily costs you 5, 10, 15, 20, $30,000, depends on how much you do it. Your kitchen, tens of thousands of dollars. And my question is always this, like, what is the actual utility of updating it? Like your oven is your oven, your sink is your sink, your fridge is your fridge. The paint is paint, the tile is tile, the countertop maybe went from butcher block to granite or something, but like, what is actually different here? And the answer is nothing, right? And we talk a lot on this program and as financial planners about how money is permission. So if clients want to spend their permission on having a nicer kitchen or a nicer bathroom, that's fine. But that comes back to the cash flow conversation, because often the ask of us as financial planners when they want to do that renovation or that update is on top of their completely normal lifestyle costs, where they might be taking out $10,000 a month, and that's fine. But suddenly 6 months in, 2 years into retirement, they're like, I really just want to redo my kitchen. I think it's going to cost me $80,000. It's like, is it worth it? Like, really, is it worth it? If you think it's worth it, if you want to spend your permission on it, that's fine. But just from a utility standpoint, what is actually being improved through this? That's sort of the question we ask. In younger people, the thing that I see is sort of this mistake of getting the raise, getting the promotion, and they mentally spend it immediately. We have a client who just got a promotion recently to the tune of like $20,000, and I gave them the conventional wisdom here as a financial planner, which is great. You should take $10,000 of that $20,000 raise and start putting it into your new company's 401k plan, because I know under your previous plan you weren't able to max it. And we've already gotten this enormous amount of pushback on that suggestion. We're like, well, why don't I put in more than I was, but less than that? And it's like, but why? You've lived adequately and happily on the money you were making previously up to this point. So why is there this sudden pushback? Because we're mentally spending this new income on other things. We're already sort of envisioning these one-time or these systematic improvements to our quality of life. And I love that. But if your saving did not keep up with your lifestyle, right? If you were saving 3% of a $50,000 income and then you want to save 3% of a $70,000 income later on, I mean, good news, you're still saving 3%, but bad news, you've now undersaved if your lifestyle is based on the $70,000 income and not the $50,000 income.
Well, sure. And I think we've talked about that a little bit in other episodes, but it's lifestyle creep. It's pretty easy to increase, but it's really, really, really hard to cut back once you're used to having XYZ or spending a certain amount. It's better to just not do it in the first place.
Oh, yeah. I mean, there's a separate conversation we could have about like what do you do when you get your first job, how much should you save, etc. But I'll give anybody very generalizable advice here. As your income increases from whatever your current position is towards whether it's a raise, a promotion, a new opportunity, a new career, whatever it is, pause along the way to just max out your retirement plan if you can. Whether it's a 401k, whether it's a simple IRA, whatever's available to you, just do that. If you make the transition from 50k to 78k a year, great. That's $20,000 of 23,500 you can put in. Do that. Right? If you go from 70 to 90, 90 to 150, whatever it is, whatever the next big step is, just try to get to the point where you're maxing your retirement out. Because if you're at least doing that, unless your income is super high and your cost of living is consequently also super high, a lot of people will be just fine in their later years if they've maxed out their retirement for a good chunk of their career. And the sooner you can get in that habit, the better. But we can always invent these reasons not to do it along the way, where we're always just saving 3, 4, 5% of our income. We're getting a match. So maybe we're saving 8, 9, 10 total. But if we're doing that the whole way, we're going to end up with a lot less in retirement savings than we think we should have to fund the lifestyle that we were living as we got to the pinnacle of our career in our later years.
Sure. What about saving, if you're maxing out your retirement accounts, you're doing all that correctly, let's say, what about the remainder that you're saving? Do you ever use that bucketing approach for things as we're talking about, these big ticket items? I want to go on a big trip. I want to divide things up. Or do you just put it all in one big savings account?
I think that really is more of a personal and emotional thing. If you're the type of person who will spend it if they have it on hand, then you probably want to have that bucketing approach. But if you're the type who doesn't tend to ever really touch their savings, who just puts in their per paycheck extra $100, extra $200, however they approach it, and you don't really ever tap into it unless an actual emergency happens, then that's probably fine. I think you really just need to sort of know yourself in that particular regard and do the thing that's most likely to work well for you.
All right. Well, let's move on to my second topic for today then. I want to talk to you about estate planning for young people. I think we've talked about it a little bit before for people who are a little bit older and, that's a little bit more well known. But when you're young, it still can be a really important piece of financial planning, but not everyone knows that much about it. They have questions of when do I need to start thinking about things like this and what do I need to do?
Sure. Let's just start this entire segment off with that magical disclaimer. I am not a lawyer. So I'm going to talk to you about estate planning from a financial planning standpoint. And to do that, I'm just going to give a very brief explanation of what happens if you die without an estate plan. Every state has what are called intestacy laws. To die intestate means that you died without a will or trust or some sort of estate mechanism to control your assets. And in those particular cases, which happens to a ton of people, then state statute dictates what happens. So state by state, that might mean that your stuff all goes to your spouse. That might mean that your stuff gets split up between your parents, your siblings, and your children. That might mean money only goes to your children. Every state has its own little set of intestacy laws. And so if you do not have an estate plan, good news, the state has one for you. It just may not match what you would like to accomplish. So in that particular context, the thing that really comes around to why younger people should or shouldn't have an estate plan, it really is just a question. If you look up your state's intestacy laws and see how it's supposed to go by default in your state, does that match your intentions? Number one. Because if it doesn't, right, if you are married or if you have a kid, but maybe you had a kid out of wedlock, so you're not married and it's a whole messy situation, do you want stuff to flow the way the state's going to decide it should flow? Or do you have more specific directions? The second thing that arises when you die intestate, often that ends up becoming more expensive because the court is more involved. You have to pay more fees and expenses, and it costs a lot more to get an attorney if you need legal help to fix a poorly structured estate than it does to just administer a well-written estate as far as the estate planning documents go. So, with that framework in mind, there's just as good a reason for a young person to at least have a will in place and healthcare directives, powers of attorney, all the basic things that come with an estate package, as there's for somebody in their 70s. We might say that the person in their 70s is statistically more likely to die sooner, but anybody can get hit by a bus. Anybody can contract cancer. Anybody can, get struck by lightning. you name it. So in that particular context, it makes sense for everybody to have some degree of an estate plan. Do you need to go work with an attorney for every estate plan? Not necessarily, right? If you're brand new out of high school, you're probably okay with, I hate to say, just like an online template, but just some version of an estate planning tool or system where you've paid maybe $200 or $300 to get professionally drafted documents that just are not personalized to you. Something like that can save you a lot of heartache. But the second you have kids, the second you have a spouse, the second you have complex assets, a business, any of those sorts of things, you really need to engage legal counsel and get that stuff in place. And I don't care if you're 21 or if you're 81, it's important.
Hmm. Well, that's a good reminder because I feel like most young people don't have a will in place, that's for sure. Um, what about the whole life insurance portion of estate planning or thinking about yourself? At what point in life do you think you need that?
the There's a really nasty conversation around this where essentially the guilt answer is, well, you should have life everybody should have life insurance because your funeral is going to cost somebody some money, and so you don't want to be a burden, so you should always have life insurance. I disagree with that. I hate to say that it's somebody else's problem, but it kind of is somebody else's problem in certain scenarios. So if you're 21, I don't think you need to run out there and go get a $10,000 life insurance policy to make sure that you get buried or cremated the way you want. um, your family will figure it out. And maybe I'm encouraging a little irresponsibility there, but I'm just sort of thinking about the push pull of that. I think as soon as there's an insurable interest, that it becomes very important to go ahead and get something like life insurance taken care of. So again, the second you are married, the second you have kids, or you may have, let's say, an adult sibling or parent who is financially dependent upon you, the second somebody would be devastated by your death on a financial level, there should be some degree of life insurance in place. Uh, Generally speaking, you do not have an insurable interest that's going to last your entire life for almost anybody, right? If you have, let's say, a brand new child, you don't need to have a permanent life insurance policy to protect that child. But let's say a 20-year term or a 30-year term to get them all the way through from K through 12 and into college is probably pretty reasonable. If you are married, you probably want to insure yourself during your working years, but it's probably not so important to insure yourself in your retired years because what loss is there? And that's there may be a loss. There's an open question depending on what your lifestyle and your income and so on has been. Or with business partners, if you want to have key man insurance or a buy sell agreement in place, those are good reasons to have life policies in place. But again, a lot of the problems that I see that arise for young people buying life insurance is they're not buying life insurance in their mind. What's happening is they're being sold an investment opportunity by, I hate to say it, almost always a very poorly educated person who learned to sell life insurance on TikTok. And in those particular cases, they're just telling them, hey, buy either as much life insurance or buy very little life insurance, but we're going to have you overfund it and juice it. And they'll use phrases like it's a rich man's Roth or you can bank on yourself or all sorts of dumb marketing terms that are all essentially just designed to juice the amount of commissions that the agent gets for selling it to you. If you are in any circumstance, I'm going to say your default answer for life insurance is the term that matches the length of the insurable need. So again, kids 20 to 30 years, marriage probably no more than 30 years just for your working years. And if you're going to buy a permanent policy, you should have gotten a financial plan done by a financial planner, preferably a certified financial planner who is not in the business of selling you the policy to tell you exactly how much of a permanent policy you need and of what type before you ever talk to a person who then is going to sell you that policy.
Right. We see plenty of people come through here that have whole life policies that they didn't necessarily need, but they've had for a very long time.
The weird thing about a lot of those too is they're like these junky little like piddly policies. Like we see a lot of whole life policies for like $25,000 that were sold in the mid '80s, and $25,000 was a lot more money in the mid '80s. But like it's this silly thing now where in 2025 they're paying like $22 a year for a $25,000 policy that they bought in like 1981. And you just sit here and go like, what is this doing? Like, it's not costing you that much, but also what is this actually accomplishing? And the answer is essentially nothing, but it was probably a good sale for the agent 40 years ago.
Sure. Would you recommend keeping it at that point? I mean, it's cheap.
Facts and circumstances dependent at that point. I'm not sure I'm really compelled to go one way or the other. I do see some good use for sometimes you see bigger policies that were purchased maybe a little more recently, something bought in the mid 2000s that has, let's say, $70 or $150,000 of cash value built up into it. And in those cases, if the insurable risk is passed, I'm often going to suggest something like doing a 1035 conversion over into an annuity to then supplement insurance or to supplement retirement income, or into an asset-based long-term care policy where again they can sort of supplement a different risk. Because it'd be one thing if they then died tomorrow and then there's a big death benefit, but if they're, let's say, 65 and they're expecting to live for another 20 or 30 years, but there's no life insurance risk that needs to be adjusted for, then I'm sort of inclined to just say, great, you insured your risk for the last 20, 30 years. Good for you. That risk is essentially gone now, or at least it just no longer matters anymore. So let's redirect and consider, turning this into part of our retirement income, or start hedging against a different risk like a long-term care event.
Sure. Well, as we're thinking about estate planning, how often do you think people need to update things, like take a look at all their insurance policies and their will and things like that? Because we also see a lot of people come through that have a will, but it's, 30 years old and not even all their kids are listed because they've had a new one since then.
Yeah, I think every time there's a major life event is a good time to sit down and review your documents, number one. So every time you have a kid, every time a kid moves out, every time somebody close to you dies, that's probably a really good time to kind of be prompted to check your estate documents. Doesn't mean you need to make changes, but it's just a good reminder. And then I would say you should be pulling these things out at least every 5 years, because maybe a life event has happened, not in a dramatic sense, but a dynamic has changed, right? You made your brother your kid's guardian, but your brother has developed a drinking problem. Now you're kind of worried about what happens if we die and our kids have to go live with my alcoholic brother. There's situations like that where I think it helps to just go ahead and reread them. And this is just another really nitpicky thing. Again, I'm not a lawyer, but it annoys me that I run into this so often. Go read your estate documents front to back. And most of it's this boring legal boilerplate. But often what I find, because I'll do this as financial planner, I'll get a client's documents, and on like page 23 of 38, there will just be gobbledygook or typos all over the place, because whoever the attorney was that drafted it, or whatever software you put it in, somebody just like made a typo or did like a bad copy and paste, and there will just be literally like nonsense gibberish in the middle of your documents, which tells me you haven't read them, because there's no way you'd miss it. And just from that context, then, if you're finding gibberish in the middle of your documents, you should have some valid concern about the professionalism and the quality of the person who's done this work for you.
That is an interesting call out. That would be quite concerning, especially if you paid someone to create that for you.
I really wish I could say that it was like a one-time thing that's happened, but I think I've run into that over a dozen times at this point, where like a cat must have walked across a keyboard or something. I just don't have a good example. I've also found clearly copy-paste documents where like people who don't exist or who are like not relevant to a client's names are just in the middle of the document. The document starts by talking about how like Maria is going to take care of everything, and then starting on page 8, suddenly Stephen is going to take care of everything, and there is no Stephen in this family. It's like there's just weird examples like this where, I hate to say it, but some professionals are just lazy copy paste monsters. And from that, before you sign your documents, just read them front to back. And when you go, if you haven't done that, now that you're listening to this, it's a great time to go read your documents front to back and go see if there's some random garbage in the middle of your documents, because that alone is a good reason to go engage a different professional to get your stuff updated or fixed.
That would be a very good reason to update it. Do you recommend people looking over their beneficiaries and their accounts equally as often as they're reviewing their wills?
Yes, because your beneficiary designations on your banks, your brokerage accounts, your retirement accounts, and so on, whether it's pay on death, transfer on death, or retirement account beneficiary instructions, will supersede all of your estate documents. Each of them is self-executing. So there was a famous example that was in the news a couple months ago where some guy had a girlfriend in the 80s, made his 401k, made her the beneficiary on his 401k. They broke up, he got married, had kids, had a whole family, for decades, and then he died and had never left the company, and his 401k was worth over $1 million. And guess who gets the 401k? The ex-girlfriend, which was clearly not going to be his intention in the present day, but just, I never left the company and never updated it. So yeah, you want to go double check on all of those, and you can get a beneficiary designation on every single account. You can get it on your individual bank account, savings account, money market, CDs. You can get it on your brokerage account, individual accounts, joint accounts, Roth accounts, IRAs, 401ks, you name it. If it's a financial account, you can get a beneficiary on it, and it is silly not to, because all you're doing is adding to the administrative burden of your family when you don't do that.
Right. And I think a lot of people assume that if they have a will, it covers everything and that it would supersede the beneficiaries, is what I hear a lot. And it doesn't.
It's then that's one of those things where you could take it to court. Like I'm sure that case with the guy with the ex girlfriend, I guarantee that's in litigation somewhere, because there's no way that the family's just going to let this ex girlfriend walk away with $1 million, over the course of the years. But in that context, right, it's not guaranteed. It's so easy to just go in and just make sure it's up to date all the time, and then you never have to run into this problem where, oh, dad died and he accidentally left money to my brother. My brother also already died, and so now we're just trying to figure out how this shuffles because he didn't list a contingent beneficiary.
Right. Easy to do, solves a lot of problems for everyone else.
Yeah. Yeah. And again, it's easy to let this stuff fall through the cracks, right? We've all moved before and we've all found like the pile of stuff in the back of our closet. We're like, oh, I remember that from my last place, and I guess I must have put it here when I moved here, and then I never saw it again. It's easy to let your estate stuff be like that. So just take the time to make sure you're keeping up on it. You don't have to do it every day. You don't have to do it every year, but just set a thing on your calendar and a reminder. Right? Hey, it's been 5 years since you last checked your will. Go reread your will. Right? It'll take you an hour to go through all your stuff in most cases. So just do it.
Yeah, that's very true. All right. Well, I'm moving on to my third topic, Dan.
Okay, this one is very different. So come at me here. What do we want to know about this?
Well, I want to talk a little bit about, who's worth following in finance. There's a lot of people, well, there's a lot of content online, both just websites and blogs and social media and TikTok. And we're just inundated with information on like how to, maximize your finances and how to invest and these secret tricks and tips that only I know, and I will share them with you. And it's like, who should we be listening to here?
So I'm going to sort of help narrow the field down really, really heavily here. And there's two great sort of things to sort of eliminate a lot of the noise. One is just don't listen to anybody who's not liable for what they're saying. And so when I say that, particularly in the domain of investments, really investments more than anything, but even more broadly in finance, the vast majority of content creators like financial coaches, financial consultants, people who just like sell financial education courses or books, that sort of stuff, almost all of them are unregulated non-experts. So we often think of somebody like Dave Ramsey. Dave Ramsey has built an enormous financial education empire, is very, very well known as a household name. Pretty much all of his advice and wisdom and suggestions are known by every financial planner and a huge amount of the public. That's not really who I'm talking about when I say that. He would actually be an example if you went back 30 or 40 years of somebody who was not actually educated on these subjects or wasn't an expert on these subjects, but he's become sort of a household name. But there's a million like wannabe Dave Ramseys out there who are doing TikTok channels, YouTube channels, who are doing Instagram content, and a lot of it tends to be, and pardon the term here, but it's just sort of success porn, right? It'll be somebody like walking around, getting out of his Lamborghini with a little selfie stick and recording a video on how he actually has his company pay for the Lamborghini, and he actually rents it back to his other companies, and he gets income from renting it to himself, but somehow he doesn't pay taxes. Most of that's just tax fraud, just to be clear. That sort of content is largely just crime, very audacious crime, but just crime. And so there's just an element here where if you're looking at somebody and they don't actually make a living managing money, or they don't actually make a living giving financial advice for which they are liable, you can probably just ignore them out of the gate. There's one or two that do great, do good content and create good information and whatnot. But it's one of those things where like there's a couple good apples in a giant sea of bad apples. And so from a safety standpoint and a kind of return on effort standpoint, you're probably better off just cutting off that entire group. And that means you'll miss out on some good stuff, but you're tuning out a lot of garbage. On the other end of the spectrum, because there's 330 licensed financial advisors in the United States, just at least in the securities realm, let alone if we get into the people who only have insurance licenses and whatnot. But on the other side of the spectrum, you're not going to see a lot of content from big name institutions, at least at the advisor level. So for example, like JP Morgan has thousands of brokers and advisors in it. And you won't really see any of them out there, doing TikTok videos or YouTube channels, but you will see really good published institutional research from JP Morgan's investment divisions on the economy, on markets, on all sorts of stuff. Like that's perfectly fine to listen to, but you're not going to see a lot of personal finance voices there.
Right. Well, okay, that does narrow down quite a bit, I will say. What a Do you ever listen to any of those independent people? I'm just so curious about that. I see them all the time on my social media when I'm scrolling, and they're talking about, like you say, the Lamborghini write off, or, you can gamble and write off this much, and it's a secret little, it's not even worth researching those people and trying to figure out if they would be liable and therefore good to listen to. You just don't look at it at all.
I hate to say that most of the time I see any of that sort of stuff, it's probably one of my peers, so another financial planner has found this and is sharing it as, I'll say, rage bait. And some of them just do it to like point out how dumb what some people say is. But there are some financial planners who are really good at finding just the most atrocious garbage and then sharing it and being like, "Look at this atrocious garbage," and then you're just forced, you're sucked in by Cunningham's law that they're saying something incredibly stupid, and you just can't peel your eyes away from it because you just get mad about it. I end up with a lot of that, but like there's some very household names in personal finance who just spout absolute garbage. I'll give a good example. Like Ramit Sethi he has a Netflix series now. He's done a couple best-selling books, and he is in the course selling business. Right, he sells these multi-thousand-dollar courses on everything from how to run a business to how to do your personal finances and so on. But the dude says stuff that's untrue all the time and has had stuff demonstrated to him like, hey, you say this all the time, here's why that is factually inaccurate, and we'll just keep saying it. Because at a certain point as well, for a lot of these influencers, they've built a business on saying something and they're not in the business of ever admitting that they were wrong. They'll just ignore you if you point out that they're wrong demonstrably, and they'll just keep saying it because it's not worth the energy to actually adjust their behavior or go update their content or whatever the thing is. So no, I don't generally follow any of the unlicensed, unregulated people because most of what they say is garbage in the first place. If I see it, it's probably because somebody else is sharing the stupid thing that they're saying. But there's an enormous amount of high quality stuff from really well qualified, really smart people in the investment world, the insurance world. There's all sorts of people that you can follow that do produce great content. And that's where I come back to this element of, are they liable for it? Under securities regulation in particular, you are required to substantiate the things you say in your marketing and in your content. So if you say something about markets, you better have that data set. If you say something about a particular investment, you better have that data set. And not only do you need to have it when you create the content, you've got to have it in the event of an audit. Because if you don't, you are going to pay hundreds of thousands or millions of dollars in fines or potentially lose your license because you're misleading the public. So in that particular example or in that particular light, the best content actually ironically tends to come from a lot of independent financial planners who happen to be domain subject matter experts, or from investment specialists. Some people who run particular ETFs or mutual funds, that sort of thing, also produce really good content sometimes. But most of the garbage tends to come from people outside of the industry. And I know it's sort of easy to hear me say that and kind of shrug and go like, well, Dan's just sort of throwing out his elbows and being territorial about the thing. But no, it's this question of liability, right? If I went out into the world and started saying this stock is the best stock ever and you've got to buy it, the SEC or the state administrators are going to be coming right after me to say, great, we see you've made this very popular post about how you should buy this particular stock. Why are you telling people that? Show us your data. Why, and show us also not only that you had the data to substantiate that suggestion to people, but that you are not profiting secretly from that recommendation and using other people in some form of a boiler room scam or a pump and dump or something like that.
Right. Well, and I think a lot of regular people don't know how highly regulated we are, for example, so they don't realize how important it is that we're liable for what we say. I was just doing compliance stuff this morning and asking you a couple questions to make sure I did it correctly because it is so important, and the ramifications of not doing it or doing it incorrectly can be so serious. I don't know that everyone else really keeps track of that or knows that.
Well, and it's sort of the cruel irony here. The reason so much of this financial coaching, financial grifting content has gotten so popular is that it is regulatorily burdensome to create good content as a financial planner. It's easier when you're a small firm where you are the chief compliance officer like I am, so you can then validate what you're doing instantly. But this is where, kind of back to the thing where you don't see a lot of advisors from like JP Morgan doing social media or any social media, is because when you have a big institution, you have to then hire compliance people to review all of the content that's going to be published or shared. And in turn, you then have to create rules and policies and monitoring that essentially assumes that you're building your policies for the lowest common denominator. So if you imagine any big brokerage that has 10,000 advisors, in just a bell curve distribution, you're going to have a couple hundred who are really smart people, and you're going to have a couple hundred who, frankly, probably shouldn't be in the business, but just by the law of large numbers, there's just a handful of very dumb people in there. You've got to build your compliance policies for the very dumb people. And so for big institutions, that often translates into just saying, no, we're not going to let you do any of this. Or if you do get to do this, you can only use canned content, and it's going to be super generic stuff like just a picture of a turkey that says Happy Thanksgiving on Thanksgiving. You're not allowed to do market commentary. You're not allowed to talk about tax efficient strategies for this or that, because there's too many of you. It would cost us too much to monitor it. So just none of you are allowed to do it.
Right. We are a bit spoiled here at the small company because I can just go into your office and ask you, is this okay?
Yep. And it's just a scale problem. I don't hold it against the big institutions, because again, the big institutions often produce some of the best research content, because not only do they have the money and the resources and the teams to do it, but they also then have the compliance focus to get that stuff right. But in turn, you tend to see most high quality financial content in the personal finance domain from small independent practices and firm owners who build a niche following in things like equity comp, or in international planning, or in how to manage just your basic day-to-day budget and money. There's a lot of great content from that sort of thing. There's a lot of great people to follow there, but they also tend to make a living helping people do that as well, versus being people who don't make a living doing that. They just make a living creating exciting stories or imagery to then get you to want to buy their course or take coaching from them or something like that.
Right. The age-old advice of be careful if someone's trying to sell you something.
Well, and there's always that caveat emptor thing. In the particular case here, I love Hearn's law. You will pay for what you get, and if you're lucky, you'll get what you pay for. If you're going to somebody who is deliberately avoiding regulation so that they can make their content sexier and therefore more exciting, that alone is sort of a red flag. Because if this person is so good at managing money, or so good at personal finance, or so good at taxes, you'd expect them to try to make a living at doing that thing first. Because if they're so good at it, surely they can make a living at doing that. And then by extension from that, they might want to create content. But no, most of the people in that genre tend to be people with no professional experience at what they're talking about. They just happen to be 1% smarter than their audience, and they just sort of make it up as they go.
That's true. There's plenty of that. I see you call people out online quite a bit. You're a very prolific commenter.
I do not have a great tolerance for bullshit. It is true.
It is very fun to follow you online and see the things you're reposting and responding to. That's for sure.
Well, now that you've sent our audience down another rabbit hole, I think it's my turn to ask you a question. Emily, what is the thing you've learned in the last couple of weeks that you think is valuable for our audience to think about or know about?
I think, I don't know, it's kind of similar to what I've said before, but planning and timing and all that kind of thing, I'm still getting a few questions from people, actually more in my personal life than client facing at this point, but they're asking about tax stuff from last year. And I'm like, well, last year is over. More or less it's kind of already set in stone. That's a broad statement, but you should have thought of that a long time ago. And now we can look forward into the next year and change XYZ, but you can't wait until the last minute to do stuff. Once in a while you can, but overall, cut it out, plan ahead.
Yeah, I mean, on some level, a lot of good financial planning is very similar to insurance. You can't buy insurance on a burning building, so you do have to get it in place before the things happen.
Yeah, that's been several conversations for me recently, so that's the big one.
Well, now that wisdom has been shared after the start of the new year, for everybody getting into tax season, get your stuff in order if you're prepared now. Don't wait until April. And by the time we're thinking about this stuff in Q4, start a conversation with a financial planner sooner than later if you're worried about how things look at the end of the year, not in January after it's too late to do something about it.
That's for sure.
The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.